Well, defence tech firm EOS, Electro-Optic Systems, has seen overall net profit rise, although it made a loss from continuing operations. Net profit to just over $18 million. It made an after-tax loss from continuing operations of $79 million. Revenue fell by half to $131 million following the completion of work related to a long-standing contract in the Middle East. Investors will not get a dividend payout this year. Well, earlier I caught up with Andreas Schwer, EOS Chief Executive, to get across the results and where the focus lies in the new future for the company.
2025 was our last year of our 3 years restructuring program, which we have successfully completed. Our major focus was on increasing our order book, and we were quite successful in signing orders last year of more than 420 million Australian dollar, increasing our actual order book of unconditional orders up to 459 million Australian dollars. So that was very promising, and because of that, we expect this year also revenue-wise to be very strong with an upwind, and we hope that we can more or less double our last year's revenue baseline by that one. We also expect this year to be extremely high in terms of order book, as we now can execute our growth strategy after having completed the transformation, after having divested EM Solutions, and after having acquired Mars, the C2 company. We are now well positioned to become the worldwide leader in anti-drone systems and space warfare or space control.
Just getting into a little more detail on those numbers then. Operating loss before tax from continuing operations was at $79 million. That's up from a 24 loss of $38 million, yet you've got an operating loss after tax from continuing operations. Also, revenue is down. Why is that?
Some of our major order intakes last year happened much later than we've expected, and obviously in direct consequence the revenue went down, but it was just a shift over time, so all that revenue will be realized in 2026. And as we are always stating, our breakthrough in terms of EBITDA, our profitability, is around 200 million Australian dollar of revenue. So we should easily this year break even because the revenue will be significantly above this kind of threshold value.
So what does your contract pipeline look like at this point?
So the 459 million are still predominantly in RWS, in remote weapon systems, but as we have signed last year, the worldwide first 100 kilowatt laser contract for an international client, and as we expect this year further orders to follow, we expect that the laser weapon order book will grow significantly this year, and the laser weapon business will become predominant over the next 3 to 5 years.
There has been some controversy over your contracts, specifically coming from Grizzly Research, in that they said that they find the statements from EOS made at an investor call, particularly in relation to a new Korean contract, was aggressively misleading. What was your response to that?
I mean, we have clearly stated that most of the accusations are completely wrong. We have substance, we have proof, we have evidence that this was completely unjustified. I think the market reacted in the right way. The share price went up again. And we made it clear from day one that this Korean contract is highly conditional. It was never ever put into our order book, so the 459 million is unconditional. It does not include this Korean order of 80 million. We made it clear to the market, and we hope that this contract will turn into an unconditional one in the course of the first half of this year.
That did obviously initially unnerve investors. Can you just clarify greater certainty over those investor contracts, over those contracts that you've signed and the ones to come? You can reassure those investors?
Yeah. I mean, the order book, again, of 459 is completely unconditional, firm orders which we will execute. And when you look to our pipeline, most of our upcoming orders are also unconditional, but there will always be some orders which will be conditional. And obviously, in terms of providing maximum transparency, we always announce also those kind of conditional orders to be transparent and trustful partners to our investors. And again, this Korean contract was announced as a highly conditional one, and it was not included in the forecast.
Certainly the brokers are highlighting the need for improved clarity. They say that they're getting that now, particularly in terms of confirmation of the General Dynamics Land Systems contract.
Yeah. I mean, that was a landmark contract. This contract is the door opener for the big US Army market. I'm not allowed to tell you which platform we are going on, but we have been selected by the US Army to become their partner for the most strategic fighting platform of the US Army, with a total potential of up to $3 billion order intake over the next 10-15 years. So this is a big breakthrough, which we were working for over the last few years.
You spoke of your recent Mars acquisition. Tell us what sort of synergies that's going to bring for you, and are you looking elsewhere for potential acquisitions?
So with the acquisition of Mars, we are now a system level partner. We can provide our clients end-to-end solutions, fully integrated counter-UAS solutions, not only for military clients, also for clients coming from the homeland security or the commercial area. So in the future, any operator from a civil airport, for example, can order systems from us, integrated systems. And with Mars, we can integrate not only our own effectors, like our own laser weapons, our own kinetic kill systems, but also third-party effectors. So this is opening for us a new avenue.
Overall, Andreas, what is your competitive advantage at the moment?
We are a highly agile company. We are among the companies being able to react the quickest on actual changes on the battlefield in Ukraine. And the kind of warfare scenario is changing very quickly. The drones are upgraded over time, and we have to always adapt our countermeasures accordingly. So speed of execution, speed of development is one key point. We have very low overhead. We are very competitive in terms of prices on the market, and our very aggressive teaming approach on going to the market by joining local champions is giving us a leading edge. In particular, when we look now into the European market, where we have started operations in UK, in France, in the Netherlands, and Germany to follow pretty soon. So we will be very aggressive in those growth markets.
Now, Andreas, more recently too, your share price did dip on speculation you were going to move your headquarters to Europe and perhaps delist here and list there. What's your response to that?
So we are considering potential move of the headquarters. This is an official activity which we have just started now. It will take some time to conclude and to see whether we move it or not, and if we move it, where to move the headquarters. In terms of listing, we have not started the formal activity.
All right, but you'd like clearly to tap into greater capital. Would that make sense?
We need to see where we can create maximum value for our shareholders, and if this is predominantly in other markets, we need to consider that seriously.